Markets have opened up mixed, subdued in trade actually following a mixed close on Wall Street. All eyes really are going to be on the all-important speech coming from U.S. Federal Reserve Chairman Jerome Powell later this evening at Jackson Hole. For the time being, you have the Nikkei, that's the one that's holding in the green with a gain of around 0.2%. But other couple of markets, well, they were a tad bit subdued. Let's see whether or not they've recovered. The Kospi should come up for you on the screen. That's still sitting with a cut of around 0.3%. And you had the Taiwanese index as well as the Straits. They have a bit of a mixed start to trade. What does this mean for the SGX Nifty? Remember, last couple of days we have fallen very, very swiftly from closer towards that 11,000 mark to around 10,700 odd. For starters, at least, it's indicating a flattish start.
Okay, so that was about Asia, but if you look at the Wall Street, the Dow managed to eke out some minor gains while the S&P 500 and Nasdaq ended lower ahead of the big speech from the US Fed Chief Jerome Powell at Jackson Hole tonight. Now, Dow ended 60 points higher, the S&P 500 ending just below the flat line, while the Nasdaq underperformed to end almost 0.5% lower. CNBC's Kate Rogers gets us a wrap of all the action on Wall Street.
U.S. stocks trading mixed after a meeting of top Federal Reserve officials cast doubts on the possibility of another rate cut next month. The Dow up 49 points, the S&P flat today, while the Nasdaq fell 38. The number of Americans filing for unemployment benefits declining more than expected last week, according to data from the Labor Department. Despite a slowdown in the manufacturing sector and concerns of a recession, the labor market remains strong. Boeing will reportedly ramp up production of its 737 MAX jets next year. The aircraft manufacturer has told suppliers it will pump out 52 planes a month starting in February, with plans to ramp that number up to a record 57 per month in June. That schedule is dependent upon the jets gaining regulatory approval to return to service in Q4. And Apple is reportedly planning to release a slew of new products this fall, including 3 new iPhone models in September. Bloomberg reports the lineup will include 2 new Pro iPhones and a successor to the iPhone XR, as well as versions of the iPad and MacBook that'll be new. Among the upgrades being reported, a major facelift to the phone's rear-facing cameras.
Well, on that note, here's some opinion on the future growth prospects of the U.S. economy.
I think that we should always be worried about a recession in the sense that we are late cycle now, and certain indicators we're always going to get lighter. We're not going to have 17, 18 million cars sold a year. That's going to get lighter. And the economy is slowing. We were at almost 3% last year. We're going to be at, we think, at JP Morgan at about 2.2% U.S. growth this year. So there are signs of slowing. But are we going into a recession? No, that's not our base case at all. We're just trending towards trend growth.
I think we've just seen that markets are extremely emotional at the moment, and that a little bit of news, good or bad, can really sway things quite a bit. 10 years into this cycle, a whole lot of anxiety about when things are going bad, when things are going wrong. And I think that the data coming in right now are just mixed at best. I think there is some concern for slowdown in the short term, but for me, no real risk of a recession. I think earnings growth actually is looking okay. 2019 is not going to be 2018. We're not getting double digits, but we've started to see some positive momentum even in the second quarter season. I think if the Fed keeps rates low, and it looks like they're probably going to cut even further, that just allows for more multiple expansion.
Meanwhile, in terms of data, U.S. manufacturing sector contracts for the first time in nearly a decade. Now, the U.S. IHS Market Manufacturing PMI was 49.9 in August, down from 50.4 in July, and below the neutral 50 mark for the first time since September 2009. The new orders received by manufacturers dropped the most in 10 years, while the data also showed that export sales tanked to the lowest level since August of 2009.
And as we count down to the Jackson Hole Summit, where Federal Reserve Chair Jerome Powell will deliver his speech, CNBC's Steve Liesman spoke to Philadelphia Fed President Patrick Harker and Kansas City Fed President Esther George, who dissented against the U.S. Central Bank's decision to cut rates last month, and both say the U.S. economy does not need more stimulus at this point. Let's listen in.
I didn't think the cut was appropriate necessarily, but I went along with it to get back to neutral. but I'm on hold right now. My forecast is just to hold where we are for one of the reasons is that I think we run the risk of creating too much leverage in the economy.
The decision at the last meeting, the committee decided to lower the rate 25 basis points. I thought policy rates should hang where they were. And not that I didn't see the downside risk. I think those are out there. But as long as the consumer seems strong, the jobs numbers look good, I thought it was appropriate to stay where we were.
Meanwhile, CNBC's Steve Liesman also spoke with Dallas Fed President Robert Kaplan, who is non-voting member of the Fed, and he said July rate cut was appropriate.
I was in favor of the rate cut in July. I felt it was appropriate to make an adjustment. You know, part of this job is to be forward-looking, and there's a risk management part of the job. And I want to take all the time between now and September to assess how the economy's acting, and I'd like to avoid having to take further action, but I think I'm going to have an open mind about taking action over at least the next number of months if we need to. And for me, the global yields, but particularly the U.S. yield curve, I'm less obsessed with whether the 2 to 10 and the movements back and forth. I'm more focused on the fact the whole curve has moved down over the last 3.5 months. And the Fed funds rate at 2 to 2.25 is now above every rate along the curve, which to me is a little bit of a reality check that says it's possible our monetary policy setting is a little tighter than I would have thought 3 or 4 months ago.
When you look at global rates, do you see that maybe you have to bring the Fed rate more in line with global rates?
I don't think we need to do that. I think the reason that global rates outside the U.S. are low, they've got some specific reasons. One of them is, to the extent you have trade uncertainty, it can affect the U.S., but has a much bigger effect on countries outside the U.S. who have a much bigger percentage of GDP. So that doesn't surprise me. Also, quantitative easing and the number of activities by the ECB and other central banks have been far more aggressive in terms of buying sovereigns and corporate debt. So I want to be careful not to follow other central banks in a race lower, but I do watch what it says about prospects for future growth.
Robert, the odds that you come on CNBC to talk on a day when the president hasn't tweeted about the Federal Reserve are very low. So here you are on another day where the president has said, noting that German interest rates are negative and that the Fed is behind the curve. And do you see that American interest rates ought to be competitive with foreign interest rates?
The answer is no. There should be some divergence, and it makes sense based on underlying fundamentals that there's divergence.
But let me just push back a little bit of that. The divergence right now is more than 200 basis points.
I understand.
That's a lot of divergence. Divergence with a capital D.
And so what I'm focused on is, in particular, is what's the growth potential of the U.S. economy. When I look outside the U.S., I'm trying to look at what's going on in terms of global growth that might affect our growth potential. And I think we need to adapt rates that fit the U.S. economy. And also, other countries have lowered their rates, their central bank rates, to much lower levels. They've done more quantitative easing. It hasn't helped to stimulate more growth. And so the other thing I would comment on, policies that grow the workforce, trade policy, infrastructure spending, policies that improve skills are probably more the center of gravity which are going to affect U.S. economic performance. And I think it pays to broaden the discussion to other policies away from monetary policy.
Well, turning our attention to the European markets, they closed lower amid recession fears, and also investors, they await Fed clarity at the Jackson Hole summit later this evening. But in terms of economic data, the Eurozone PMI climbed in August to around 51.8. That's from the reading of around 51.5 in the month of July. That's what was a little bit better than what the analysts were estimating out there. Meanwhile, minutes coming in from July 25th meeting shows that the ECB policymakers suggest a combination of measures may be needed to prop up the Eurozone economy.
Okay, let's shift focus now to the world of currency because the dollar eases ahead of Jerome Powell's speech as market awaits any hint on measures to address the worsening global economic outlook. Japanese yen, meanwhile, holds steady versus the US.
Well, turning our attention then to the world of commodities, crude oil prices yesterday were holding at around $60.50 per barrel. Well, they've come under some pressure amid the ongoing worries about the health of the global economy and lingering recession fears.
And before we take a break, here is an exclusive coming in for you. CNBC's Christine Tan spoke to Ray Dalio about where he sees the trade war headed and the impact on the world economy. Here is a slice of that conversation.
What is Chinese, I think, and what is the Chinese culture, largely has to do with Confucian roots and how to get things done. And it's more top-down, okay? The United States is very much more bottom-up. The United States is a country of immigrants, of coming from all different particular places and all different approaches. It's a bottom-up type of system. So what you have is the conflict of cultures, to some extent, between this bottom-up type of system and this more top-down type of system. Of course, from a Chinese perspective, the Chinese want the government to cooperate with the businesses, wants to cooperate, and that hierarchy works that way. But at the same time, what you're seeing in China is an entrepreneurship and an appreciation. So you're seeing a lot more control from the top down in terms of some aspects of, like, be a good citizen, stay out of politics, be a good citizen. And at the same time, what you're seeing is a creativity now and an entrepreneurship that's taking place. So you're seeing venture capital and great ideas.
So China is hungry.
China wants to be all that it can be, right? And so naturally, that competition. And then when you look at it, each has its pros and its cons, right? So, like big data. China has, in an era of artificial intelligence and free access to big data, that produces competitive advantages. Issues like the privacy issue cuts both ways in terms of commerce, so it's got pros and cons. So when you look at this, it's sort of a competition of approaches to life, right?
So given your deep learnings about China, any advice you would give the Trump administration or future U.S. lawmakers about how to deal with Chinese leadership?
I would say that a tough negotiation in which there's an exchange of things is good. That's appropriate. That's respected. Be a tough negotiator. When you go beyond that, so that there are threats or disrespect and harm, that naturally you should expect compensating reactions. And what we worry about, and I think is a reality, is that in this new world of adversely affecting each other economically and hurting each other's business, each tries to think, now, how can I do the other the maximum harm? And the Chinese are clever at doing that. So you have to think about how to achieve that balance in the best possible way and emphasize